You're going to see some things that you'll say, hold on a minute, Gavin, that's the opposite of weakness. And the thing looks that if you turn the whole chart upside down, we'd have the opposite. Well, that's exactly right, isn't it, Philip?
Exactly.
If you turn the chart topsy-turvy,
yes,
it's the same thing.
Yes.
Now, that sounds, again, you look at that, but when you see this, it's exactly, if the market's bullish in the bull run, we're looking to take trades at the bottom of an uptrend channel on low volume, narrow spread tests.
And as proof of that, you could print a chart out,
turn
it upside down, and you'll see the principles upside down.
Absolutely. Right,
That's
now,
a good way of doing it.
One of the things I'm going to show you here at the end is the trade I took at the New York Traders Expo. Why I took it. The person who was trading, not against me I wouldn't say, Greg Capra from pristine.com, actually said, I think I wouldn't have taken that trade, and I thought, well, why not? That's about as high probability as it gets. And as it broke out, I mean, it was like, this is going to keep going. And I'm going to show you, so you can, at the end of this, I'm going to send you all a link to the video. Please go and watch it. You can watch a short clip of the video, and then you can watch the whole 1.25 hour presentation. And when you see the trade that I take, it's right at the very end. Look at the reason I didn't take a trade initially, but what my analysis was, and then look at the end. Look at the chart for the end of the day and see who was right, who was wrong. And I think you'll find it's not so much right or wrong. It's I could see what the market was going to do well in advance. I'd spoken to Tom in the morning, and he'd said this is bullish, Gavin. And really, I already had in my mind the setup. And I think you'll hear me say, in fact I did say on the video, the heavens are looking down on us, that's the perfect setup. But that happens every day. Somewhere on some chart, you'll see it. And I use the scanner, Philip, to find the signal. I was looking at the 15-minute S&P where you saw the presentation. So I was trying to get on the bigger time frame for the bigger move. But actually the 5-minute NASDAQ down to the 2-minute gave me the entry. Well, we'll show that. So what are signs of strength? They're down bars, okay? Narrow spread closing in the middle or low. The volume can be high or low, much the same as signs of weakness would be signs of strength, but this time they're not on up bars, they're on down bars. And let's remember, a down bar is a price bar that closes lower than the bar behind it. Okay, that's important. A narrow spread on the bar indicates there's no professional selling there. This buying will prevent any attempt to move up, so their narrow spread means they're buying on the down bar, not selling. Ultra high volume down bars. Now these are the classic moves of smart money, as we're going to show you. It's a trap most often, especially to catch people, you know, who are basically short and they want to get them to add to their positions. But actually widespread down bars on high volume are very, very strong if they're immediately tested, as we'll show you. If you get low volume, it's just telling us, much the same as the upside, that professional money is withdrawing its interest to the downside. Now, if you get high volume on a down bar, it tells you that professionals are buying into the public selling. And a great chart that you can find to prove this and how it works would be the chart just after the September 11 attacks in 2001. And do you remember, Philip, the newscasters all over the world were, you know, Tony Blair, George Bush, doom and gloom on their face, Al-Qaeda everywhere, the financial markets could collapse, people are selling.
Absolutely, yes.
Now the professional money, the VSA experts as well, were thinking, well, look at what happens here, let's have a look at the chart. And you'll notice for 2 or 3 days the market plummets, volume's high, but then on that last day, I think it was the 3rd or 4th day, you get this nice little gap down thing and it's a nice narrow spread. Now, bag holding, we're going to show them. But this is the professional money opening up their bag, saying, well, give us all your shares, people, because we know this is going to be a bull market. And we're bullish here. Nothing wrong with these stocks at all. You're just listening to the news. They closed the bag and the market went to bull run for several weeks, in fact, several months afterwards.
And this had followed a period of falling prices already before that.
Yep. So it was an ideal opportunity to take, you know, they didn't know that it was going to happen, but sure enough, it was an ideal opportunity. Right then, Master?
Yeah.
We're just talking about bag holding.
Yeah, I had a few minutes.
Yeah, well, bag holding. Now, tell us about that, because we're going to talk about bag holding in a second. But when we said the end of a rising market signal is my very favourite signal at the top, to short, my very favourite signal at the bottom is bag holding.
Yeah.
Can you just explain the principle of what a bag holding is?
Well, bag holding is the opposite to the end of a rising market. It's the last. I have seen bag holding since, but the obvious one was that all the old timers like us, we remember when Lawson resigned. When
he was the Chancellor of Exchequer in the UK.
Lawson, Chancellor of Exchequer resigned because the pound, England was in such trouble. the market plummeted down, gapped down, but it was a narrow spread, massive volume. That's bag holding.
Yeah. Now, why do you call it bag holding, though? I don't.
It's just a term I think Wyckoff or somebody came up with, which isn't bad. Professional money say, okay, they hold the bag up, throw them all in, we'll take the lot.
Now, you just mentioned Wyckoff. We haven't discussed Richard DeMille Wyckoff today, but I wanted to honour Mr. Wyckoff because
he's obviously the guy who invented the original Wyckoff concepts, which, thanks to computers and one thing and another, we've been able to improve on, hopefully.
So, what really, Richard D. Wyckoff, let me just give you a brief. I think most of you know him, but if you don't, he was a trader in the early 1900s up to the 30s who recognised that the markets did not move randomly or by accident or anything like that. They were moved by the trading of the composite operator. Now, when he discussed the word composite operator, it wasn't one person or one syndicate. It was the consensus of opinion amongst all the professional traders at the time who had the big accounts about where they wanted to move the market to. Is that right, Tom?
That's right, yes.
And he called it the composite operator. And he also introduced us to the term tape reading, which is in fact what Trade Guider does. It reads the tape, it reads the volume.
Well, if you look at a 1 minute chart, that's almost tape reading. I mean, there you are. You get the movement of the vehicle you're watching, the high, low, close, and volume, and of course the volume's underneath. That's almost like tape reading.
Yeah. Now the tape is the volume now, and basically in effect. And
yes.
What the concept of VSA is to do is to enable the trader or investor to read the professional money and to take a somewhat contrarian view, Philip, of maybe what they're hearing. Yeah, and I know that's how you trade. You don't always listen to them. In fact, you said today, should we buy a newspaper and go back to Tom? We were going to buy the Financial Times. We were going to come in and just say, Tom, look, this stock here, they've told us it's going to go up, so Philip and I are going to go buy 1,000 shares tomorrow. And we know what you'd do. You'd probably smack us around the head because you'd probably short it. But let's look at one of the first principles now. This is called a bottom reversal. It's the opposite of a top reversal. It's a widespread down bar closing on the low. The low and the close is lower than the previous 4 bars, followed by an up bar and a wide plus spread calling on the highs. Now this will arrive in a variety of versions, but basically the first down bar is what we call a shakeout, usually on, and we've called it so-called bad news. Now we've seen this. I mean, I'll just give an example here. The banking sector earlier this year, Philip, January. Okay. Now, can you remember the news in England and in America? The governments were taking over Goldman Sachs, apparently. They were loaning them all this money. There was a TARP funds, all this nonsense. You see, now, the chart never lies. Now, we now know, with the benefit of hindsight, that the banking sector led the rally. But that was surely the news in January and February would not have encouraged you to buy banking stocks. And yet you yourself looked at Barclays and said, well, that's beautiful. As we're going to see. It's one that you like. So, what did you, when you're looking at your fund, do you just completely disregard the news and look at the chart, or do you think to yourself with a wry smile and laugh, think of Tom sitting there going, oh, well, there's a buy? I mean, I remember Tom ringing me in November looking at Goldman Sachs stock. He said, well, if that isn't a buy signal, I'll eat my hat. Exactly what he said. He was right.
I must admit, I do listen to the news.
You can't help it, can you?
More for entertainment than anything else, actually. It's quite entertaining listening to some of it. And some of these TV channels, I don't know how they manage to fill an entire day's...
Oh, you should watch CNBC over in
America.
Oh, you do?
Well, I do watch it in the UK. It's actually quite good at times. It's quite entertaining. But I think one of the things I find useful is if you listen to that and you hear them panicking, say the market's been falling for some time, and they highlight just how bad things are and the market's going to collapse and everything's bad, there's your opportunity. And if you go and look at your chart will more than not confirm it.
Yeah. Tom, you talked a little bit. I mean, we have a pundit, you probably know him, in America, called Jim Cramer. I don't know if you've heard of Jim Cramer. I think you saw the video, didn't you? Now, for those of you who haven't seen the video of Jim Cramer, there's a very important video you should go and watch. Get your pen and paper out. You go to youtube.com and just type in Jim Cramer market manipulation, and that's one subject line. Or go to Comedy Channel, I think it's Comedy Central, Comedy Channel, type in Jon Stewart. You could just type this into Google, actually. Jon Stewart, spelled S-T-E-U-A-R-T, interview with Jim Cramer, and just go and watch that. and then you'll know what you're up against, and that's all I'll say on that. But Comedy Central it is, says Sheenan, thank you. It's the Comedy Central channel. It's Jon Stewart, who I admire greatly, a great presenter. If you really want to know how the markets work and hear it from one of the apparently recognised experts, then by all means go and look at the video. So now we look at a bottom reversal. Okay, the second bar is rapidly marked up to lock traders in if you shorted, or out of the market if you wanted to buy the market, because human beings hesitate buying because it now appears expensive, and then human beings don't want to buy something that's gone up in price. Sometimes they want a bargain. So let's have a look at this. We're going to look at JP Morgan, okay, again one we've been following. Now we see here, look, now notice that the market has fallen, which it had done, and we see an increase on the wide-ranging bar here. Now notice this bar here, it comes down, it closes just off the low of the bar, but this bar then closes up and takes out the bar behind it, okay. Now this is almost the opposite of it is the opposite of what we call a top reversal. But what makes this whole thing so interesting is we get this bar here that, if you didn't have the uptrend in front of you, would look like an upthrust. Philip, why isn't that a genuine upthrust?
Well, if you look at the previous bar in isolation looks as if it contains supply, because it's an up bar and it's got an increase in volume.
Yep.
But the whole point about that is that it's taken out the high of the previous bar.
That's important.
Now that takes effort to do that. Remember, it's effort versus result.
That's another.
The effort is the increase in volume. The result is that it's managed to take out the high of the previous bar. That shows strength to do that. So we know that there must be some strength in there. And that's one of the, again, that's a rare occasion where an up bar with increased volume can actually show some strength. And
you wouldn't do anything there on the trade here. When the next bar closes up here, as you see, you've immediately thought, well, that the strength here is held. This next bar is almost like a test. Now this is an up bar. The volume is left on the previous two bars, Philip. It's not no demand. Just that to me looks like an up bar test. It's almost pushed down. The volume's pretty low, and it's risen to close on its high, which I would consider to be bullish.
On a smaller time frame, that's probably testing the supply on the previous bar with a narrow spread increase in volume.
You mean like a 4-hour or 2-hour chart? Or something?
Yes.
Yeah, because the daily charts look slightly different.
Yeah, if you went down a smaller time frame, I think you would almost certainly see that's a test. And just going back to that 2-bar reversal again, that second bar is, if you like, that's a form of absorption volume. We talked about that on up bars, and that's really what you're seeing there.
Yep, absolutely. And then of course we do go up in an uptrend, and you'll notice that we do get tests. Real nice ones, which we're going to come to. I'm not going to focus on those, but you do get really nice testing. Okay, Bradford Brown just actually went and looked at the chart on the 30-minute, and it's got a big green signal, no supply test.
Excellent.
So for those of you who want to check that, okay, the date down here was the 6th of March on the weekly, and if you go down and you go to the daily charts on there, because this is a weekly, if you go down to the daily, you'll find no supply test bars, and if you break that down during the day, you'll see no supply tests all along there. Okay, AMET. Now this is one that you picked up, Philip. So can you talk us through that one? Because I'll talk about where the green bar is, the green arrow. I'd like to talk about the significance of that. But if you can talk about the bottom reversal again and what happens here.
I think that's Applied Material. I believe that's a Nasdaq stock from memory, or an S&P stock, which I picked out. Again, you've got first of all, you've got a period of falling prices before bar A. That's important before you get a bottom reversal. The first bar is down. Bar A is a down bar. It's closed off the lows with an increase in volume. But what's more important is bar B, which is pushed up, and it's closed just above the higher bar A.
That is a perfect bottom reversal, isn't it, on that volume? That's
a textbook example. That one.
You see that at the bottom here, and then you get a test here. Isn't that great?
Immediately testing the supply on bar B straight away.
And then succeeding.
Yes.
Yeah. So there, take that. That's 3 bars there that when you see that, widespread down, volume is very high compared to the previous bars. The next bar goes straight back up, takes out the previous high of this bar, closes up on the high, so there has to be some buying in these 2 bars. Then it comes back into the body of the bar. The volume's much, much lower, as you can see, than most of the other bars. And then the next bar closes higher, and we begin to go up. Now, you say, well, if I was long here, we suddenly get this happen and we come back down into the same area. Now, Philip, why do they do that? Why do they bring the market back down into that area?
Well, they probably want to continue their accumulation phase.
Now, what would happen here? Now, someone's long here. Would you use a trailing stop to lock in profit as it moved up? Because you'd certainly got stopped out on this bar here. And as it's come back down, and this has happened to me several times, where you move a stop with the price, you put it below the low of the bar in an uptrend. Now, this is a simple uptrend. You've got an up bar, level bar, we ignore that, up bar. Suddenly we've got a down bar, we've got 3 down bars. You'd have been stopped out. So you think to yourself, oh, was I wrong here? Well, actually, you know, when we see this bar here, where this was first acting as resistance, if it comes back up to there and pushes through it, and then comes back down to C, to that price area, and we see a clear no supply bar, which we'll talk about later, that is another great place to enter a trade. Don't be frightened to get back in.
We should also just point out again that we ignore the volume on that last bar, don't we?
Yeah, what Brad just said, but its first move off the bottom is high probability of going back down because the lows, as in Wyckoff terms, is an automatic retracement from shorts closing out and some buying in. Yep, I'd agree with that. So, and then AB up to C is a low volume up move. Okay, AB up to C. Yep. Now that's important. What Brad is saying here is after the buying here, as they've moved the price up, there's not a lot of professional effort to take it up because they want to reaccumulate down here. Which is something that happens.
Yes.
So sometimes you're going to see it. We're going to show you an example in a minute, actually, of a stock that churns and continues to churn. And I think it's Citibank, isn't it? I believe, where it's got some absorption going on, and this is something that, you know, we talked about distribution at the top there, the way it mushrooms over. Now, when they're absorbing, I beg your pardon, accumulation.
Yes.
That's what I meant. Accumulation. When professional money are accumulating. Okay, accumulating something, they do it over time. They don't rush in all at once.
No.
Okay, is that why we get that sort of? Well, Tom, you talked about the saucer shape.
Yes.
Now, Wyckoff talked about the market moving in phases, particularly the stock market. You had the big down move, and then you had this sort of consolidation at the bottom, and then you begin to get an uptrend. It's almost like you've got, as you said, this saucer shape. So the best place to really buy the stock is when it starts to break out to the upside. Correct?
Well, normally, if a stock is under accumulation, you will see the saucer shape, but very, very often, I think he called it a springboard, didn't he, where you get a shakeout just before the up move. If you could spot that, that's a perfect place to go in. Whether that they do that so much now, you'd have to look at it, but there's inevitably a test before they start moving up.
Yeah, now I've put in this yellow, some of you can't see what I've written in here, but it says let me explain it. What I've said here, because this stock, this was taken only a few days ago, so it's actually fairly current. Okay, so it was so it's 27th of Feb on this bar. So here, what I'm saying is, if we're going to look at buying this stock, we're going to look to go into a phase of accumulation. We certainly should have some support here, around £11.50, and we know we've already got resistance at £13. Now, if we break £13 and start to go up, I've got a target above me of £15, so that could be a nice move. But to buy it, I've put here, look for a test or no supply above C when we break it, and we'll make that clear in the next few slides. Okay. AMAT has a low of 11.30. Sorry, that's dollars. I beg your pardon. Let me correct myself. AMAT has a low of 11.36 in October 2009 and just above 10 back in June. Now that's interesting as well. So what we can see then, this is a US stock. It's one to watch, okay, and one to keep an eye on, because we've got this here. The volume here, Philip, it's not massive. Would you prefer to see higher volume on those bars, or are you happy with that sort of that volume on those two?
For true accumulation, I would want to see higher than that.
Yeah,
definitely, because you've got a downtrend behind you. What may be, I'm just looking just to the left of that green arrow, you've actually got a down bar there with much higher volume. Again, that could be the start of accumulation.
Yeah.
We don't know at the moment. We have to wait and see. But
so the jury's out on this one, but we'll follow it, see what happens next week. But certainly this is a daily chart. We've got some areas here, we've got some support here, but you wouldn't buy this because we're in a downtrend here and we're moving sideways. You wouldn't do anything with it, in fact, until you've got some sort of clear picture and some sort of clear idea as what the stock's doing. So when we go long, after you see something like bottom reversals, when it appears, there'll be a downtrend in place, as we've seen. It often, but not always, will mark the bottom, okay, or a turning point. It doesn't always do it, so keep that in mind. Now, what have I written here? Wait to make at least 3 higher lows on the bar, okay, and that means that we're actually seeing the price moving up. Then look to enter on a low volume down bar, a test, no supply, or my favourite signal, a test in a rising market, which is the best one. Tom, would you agree with that?
Well, that's the safest bet. A test in a rising market with strength in the background is your safest bet.
Yeah.
Very, very low risk entry to the long side.
And that indeed was the trade from the New York Challenge.
Yes.
Same thing, you saw it. The signal actually came up. Did you see that?
I didn't actually see it.
They're both signal. Well, you didn't see it as it came up, unfortunately, because
No, I heard it.
the other guy was talking. But when I said I'm in, I got 2 signals next to each other as it happened on the 2-minute chart. But then the 5-minute and the 15 confirmed when we closed the seminar. But anyway, okay, so that's where we go long. Now, the simple trending system for going long is exactly the same, but the opposite, should I say, rather, as the system for going short. This time, you're going to identify a serious sign of strength, such as a bottom reversal, a selling climax, okay, or ultra high or low on ultra high or low volume, okay. Look for shakeouts, which we're going to show you in a minute. Then these should be followed by a test or no supply bar, or indeed the test in a rising market. All 3. We're going to talk a lot about testing when we get to that section. So I know a lot of you have got questions on testing, so wait till we get there and we'll be able to answer those for you. Wait for at least 10 bars in any time frame. You need to see the result. Philip, you mentioned effort versus result. So you've got cause and effect. Well, you've got supply and demand, cause and effect, effort versus result. 3 universal laws that drive the markets. So we need to see, after you've seen an effort, you've got to see the result. Otherwise you don't know what it's done.
Exactly.
That means you have to be patient. How important is patience, Philip, in trading?
I would say probably 90% of it.
Totally agree.
Patience and, well, discipline is part of patience, I always think.
That's true.
Most traders that I've met that are losing money are totally impatient.
Yes,
They
yes.
have no idea that they just want the thrill of the ride. And yet, you know, you've got a whole year to make money potentially. And the thrill of the ride, you know, sometimes the best traders I've met may well sit there intraday trading and 6 hours see nothing. Rob Hoffman's a great example.
Yes, yes.
Who runs one of our trading rooms, and he'll sit there patiently, not doing anything. Tom, oftentimes they move it up quickly away from the danger point without down bars on the daily to lock you out. Any suggestions? So oftentimes they move it up quickly away from the danger point without down bars on the daily to lock you out. I think that's what Morris is. I'm not sure of the question, Morris, but let me try and see if I can. Well, let me get to a chart because I think I know what you mean.
I think I do.
Yeah, do you know? Yeah,
Think
we've
so.
got some charts on it as well. Let's
Yeah.
Philip, do you want to cover what you think he means there?
I think what he's saying there is that once you've got some buying coming in, sometimes they'll just push the price up so quickly
Yes.
that you don't get a chance to get in. You don't necessarily always get a test.
Yeah.
And
Is that right, Morris? So they just keep it running every day, yeah? Is that what you mean?
It's another form of locking traders in or out of the market.
Yeah, that's Morris, that's right. So that again, sometimes the market can be so bullish, as we're just about to show you on a stock, that you don't even get a test.
No, that can happen.
It happens, and you know that's part of trading. We don't, you know, you mostly get tests, but I've seen markets that are so bullish. Or we've got one example here that tests once and just shoots up, haven't we? It's all coming on, Morris. Well, we'll show you the charts that we've got, and it'll make sense. In the first bullet point, sign of strength, is ultra high volume or low volume signs of strength, or is there missing context? No, sign of strength can be ultra high volume on a down bar or low volume on a down bar. Now that again, Scott will confuse. So, Tom, strength in the market, ultra high volume down bar, widespread, next bar up like a shakeout. Now the volume is very ultra high on the down bar. How can that be strength?
We always remember that, as far as we're concerned, strength, when it appears, always appears on the down bar. When weakness appears, it'll always appear on up bar. The reason why this is, professional money at the lows have to buy into weakness, not putting the price up against their own buying. They're waiting for bargain day. And the exact opposite is true for the upside.
Now, a shakeout then, I mean, let's talk about that. We're going to show an example in a minute, Scott, so we'll talk about it. But a shakeout is a down bar, usually on very, very high volume. Okay, it'll usually happen by surprise, usually on bad news as well.
Always on bad news.
Yeah, well, which we're going to show people, and you get the shakeout, and it's on high volume. But then we've said in this particular slide, you can also get strength coming in on low volume. Now that will be the test. Now that confuses people because you just said high volume, shakeout, strength, followed by a test. But again, Philip, what did you say? You remember what we said earlier when you came out from the break? Repeat.
Always the low volume down bars will be the confirmation signals.
Correct. Scott, take that into account. You've got two types of VSA setups. You've got the ultra high volume warning signs, and then you've got confirmation by the other low volume bars. It's two types of things. Okay, well, let's get to the charts and you'll be able to see it. But let's look here. This is what we look for an uptrending market, and we'll show you some examples as we go through. Wait at least 10 bars. In a strong uptrend, we should see, this is very important, this line, so keep this in mind. We should see decreasing volume, but not excessive or ultra high, on down bars, and increasing volume on up bars, but not excessive. Now, when we go at the end, when we send you a link to the seminar I did in New York, look at what happened to my trade. I was under a little bit of pressure there, but I took a position on a test. It responded positively, shot up, and this time the volume was excessive. It was only a 2-minute chart. Put a big red signal on it, and I decided, because I only had 10 minutes left in the competition, or not, whatever it was, challenge, to execute my position, take my profit, which I did. The next bar immediately tested. Ironically, as you'll see from the video, I had my target a few points above that. And what happened, Philip? It tested and went straight up, didn't it? So sometimes you're going to see that happen, okay? You'll get excessive volume that's immediately tested and they'll push it back up again. That was only on a 2-minute time frame. In an uptrend, you can allow for one down bar if they're on low to average volume. Ignore level bars or near level bars, just like we did in the other downtrending system, and that is a bar that has closed at or near the same price as the previous bar. The end of the uptrend is often seen by 2 consecutive down bars followed by a no demand up bar. Yeah, pretty clear.
Could I just come back to one thing you said?
Yeah.
The third point down you mentioned, increasing volume on up bars. I think that's important. When the market starts to move into a bull phase, to continue going up, it needs to gradually bring more and more people into the market. And that's where you see the increasing volume on up bars. But it's important it's not excessive, because if it's excessive, it could be enough to stop the up move. But you need to gradually bring more and more of the herd in as the market goes up. More and more people don't want to miss out on the rising prices, so they start buying, and that increases the volume as the market goes up.
And what happens if you suddenly see a big surge in volume? And immediately you think, well, what are professionals doing here? They're going to unload something.
Yes.
So you know because the volume that we see is the professionals when it's ultra high. They're seeing the opportunity to say, look, we've got them involved. Let's sell a bit to them.
Yes.
It doesn't always mark the end of the market, does it?
No.
Sometimes they'll sell a bit, bring it back down, and then it'll rally again.
Again, it may be that it's not all the professional groups doing this, because what we're looking at here is the consensus of professional money.
Yeah,
we're not interested in what individual groups do. We're interested in the consensus.
Yeah, David makes a good point. He says, why one down bar for longs but 2 up bars allowed for shorts? And that's just through study. Go and try it for yourself, David, and you'll see that actually works. It's through trial and error, and it really is. And I will say that sometimes you've got to have a trending market to make this work. If you hit whipsawing, it's going to take you out because it will whipsaw. But that's fine. You know it's whipsawing. But it definitely, Tom, you said it was easier to use the trending system in an uptrend than a downtrend.
It seems to be that way. It seems to be like,
but you don't know why.
It seems to be that way. Well, I do know why.
Okay.
Because as soon as the bull move starts, to keep the bull move going, professional money has to support each up move.
Ah, right, okay.
They must not lose control of it, because if they do that, sellers will come in and could swamp them, and they would lose money. So they have to support the market every day. But in a downtrend, they're not really interested at all. They just let the market drift down, and that's to make sure that people don't get the opportunity of covering their positions. That's why they become weak holders.
And that's why we allow 2 up bars and not 1 dip bar.
Well, it's just the way it works, yes. You usually see sometimes the very first up bar is on no demand, and even the second one can be. But you're sure enough in a weak market you see all these no demand up bars.
And David, simply, if you've got the trending system, the diamond trending system in the Trade Guide software, that confirms this as well. That is linked to it, and Tom has just developed a new volume thermometer, haven't you, Tom? Which is much better, and we're going to add it to the programme.